the Financial Survival Network. Now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Is it us? I'm here with Craig Hemke, tfmetalsreport.com. Is it us, or are we really deep fakes? And is this just a big AI simulation? Craig, hey, one sim to another here. Here we are.
If it was a couple of deep fakes, it wouldn't be our two mugs on here, that's for sure.
Yeah, probably true. It'd be Brad Pitt and George Clooney.
Right.
Conversation now. Right. And hey, in the meantime, we're in the midst of a banking bankruptcy, a banking collapse. It's global. I mean, what's keeping the banks in China from shuttering right now? Their equivalent of the Fed just pumping out unlimited amounts of currency units. Same thing with the EU. All those banks are insolvent. They're all ready to collapse. I mean, I guess in a technical sense, the big banks aren't in the US aren't on the brink of collapse, but they're certainly in a weakened state after what's happened.
It is a laughable notion what's being put forth here on May Day about how, this First Republic thing's over with, so now it's all good, Kerry. Don't worry, everything's fine. The bond market sells off and the dollar rallies, and come on, man. Two things on that. One, I guess the beginning stages of this crisis have come from all of the unprecedented rate hikes by the Fed, taking us from 50 basis points in the 10-year note to 450 basis points. Running the 2-year note from nothing to 5% in about 18 months, right? They got so far behind the curve because of their transitory BS they tried to lay on everybody, that then they run off on this unprecedented scale of hike, as if, oh, don't worry, everything's fine. I mean, they're just making it up as they go, and they're still making it up today with Treasury officials and Jamie Dimon and the rest trying to say, oh, no, that's it. Banks are sitting on a trillions, really, of debt that is mispriced on their balance sheets would be a way to put it. After the financial crisis, FASB came up with the ability for them to mark bonds to maturity. They have ones that are in a basket that say they're eligible for sale, and they got to mark those to market, but then they can put others in a basket that are marked to maturity. Well, the problem is you get a rush for, people wanting to take their money out, which now can happen in a matter of minutes, the way everybody's online. And the ones that you don't think you're ever going to have to sell, and you're carrying them on your books at par, are actually worth 80 cents. Now you're upside down. So the notion that the only two banks, Kerry, there's two.
Oh, there's only two, right?
There's only two. Silicon Valley Bank and First Republic. They're the only two. Okay, fine. The other part of this, now there's three parts. The other part then is commercial real estate, which you and I have been talking about since COVID in 2020. This was eventually going to be a problem, not only just from an economic slowdown, but all these businesses that, with people now getting used to working from home, they don't need 10,000 square feet anymore. They only need 5. All that stuff. Now, who does most of that commercial real estate lending? That's your local bank, your First National Bank of Pittsburgh, right? Okay, so this is a problem at the local community bank level that's only going to get worse. That's going to create, even as that crisis works, that's going to create more bank failures. Third piece of this, then, what's the natural response of your local banker, the guy in the blue suit and the red tie? He's going to just start calling in things. Just say, you know what, we got to lay low here for a while just to protect ourselves at our venerable institution. We're going to tighten our lending standards. We're not going to make as many loans as we used to. And so the whole thing has this cycle of tightening and making the economy even worse. And then you spin it all back to what, the notion going around today is the Fed higher for longer and everything's fine and strong economy. Right. Well, we'll see about that.
Best economy ever. Hey, right. But, like I'm looking at the money supply figures, M2, and basically it peaked in July of 2022. And it's been going down slightly, but we can't afford a declining money supply when debt is going up and all these bailouts are taking place. I mean, it's kind of counterintuitive. The other point I'd like to make is there's another stool of this lug that could conceivably collapse, and that is who makes all of these big office building mortgages besides the regionals. It's the insurance companies.
Yeah.
All right. No one's talking about the insurance companies, but I guarantee you, under Dodd-Frank, they are considered to be a vital non-bank institution that the Fed and the Treasury can bail out upon concern. The only thing is they don't have to mark their mortgages to market, but they're holding a lot of the paper, because when you go to any city and take a ride downtown, it's all insurance company names on those buildings and banks. And those insurance companies aren't occupying all that space.
Right.
So there's an insurance company issue, and there's a difference when there's a run on an insurance company than a bank, obviously, but the effects can be equally as devastating. So what are the odds that these insurance companies are turned into banks, just the way the big brokers were in 08 and 09, so that then the Fed, they can go to the discount window and get money.
Right. And actually, I remember many of them still are. Remember, like, even Mutual of Omaha back in 2008 became the Mutual of Omaha Bank. Like, what?
Exactly.
So that they could all pony up at the discount window or whatever and get their hands on overnight cash whenever they needed it. And again, I guess to relate this to the precious metals, I mean, at this point, you just wait. We just wait this out. I mean, they give you this garbage day after day, and the metals do their thing, go up, go down day after day. And it's silly. But I think Kerry, it's like the old adage, we've seen this movie. We know how it ends. So why are we even paying attention during Act 2, right? It's like, okay, I remember this is where they do this, and this is where she said that, and he says this. And when you know how it ends in the end anyway, and that's where this is all headed. They can pretend and paper over on a daily basis, no pun intended. But it's a triple-headed issue. What the move in interest rates has created balance sheet issues, easy runs on banks because of where we are in 2023 from a technology standpoint. Commercial real estate is an absolute building disaster, no pun intended, building. And then ultimately that causes banks to lend even less, which makes capital, working capital, everything else harder to come by. And it just exacerbates what was already going to be a recession and a slowdown. And again, anybody can see this. What you can't be is misled by somebody that probably has an agenda, like a politician or a banker. Kerry, before we start recording, I saw something on Twitter about the recent holdings. I don't know, I can't remember which senator it was, but then on March 16th blew out of his First Republic Bancorp stock right before it crashed. And on March 22, bought a whole bunch of JP Morgan. So what, they didn't know all of this, obviously, 6 weeks ago? So everybody has this interest, their own personal self-interest regardless of the ethics or the morals or the laws. And they're going to say whatever they can to kind of front run everybody, to protect themselves. So don't fall for this crap about it's all over and everything's fine. And one last thing. We were 2 days away from another Fed rate hike. We just had the second largest bank failure in the U.S. history in terms of size of their deposit base. And yet the Fed's going to hike.
There's something wrong with this picture.
My goodness gracious.
So how long does the whole charade keep going, though, is the question. We've been in this situation many, many times, you and I together over the years, and it keeps going, right?
Right. Well, and again, as I relate this to the metals, you recall from our previous discussions this year, I write a thing in the first week of January every year, just if anything, just to kind of make myself think the year through and then hold myself accountable. And so what I wrote in January this year talked about, hey, look, none of this Fed hiking higher for longer crap. The Fed will be pausing and then cutting by summertime. Not all this bank stuff notwithstanding, just that the economy was going to roll over, and we have an election year next year. And what do you think Bernie Sanders and Elizabeth Warren are going to have to say about Powell if all of a sudden we're deep in a recession in the first quarter of an election year, right? Mm-hmm. And he wants to keep his job. So it's obvious what's going to happen. And we've, again, as you just said, Kerry, we've seen this before. You and I have talked about this before. In 2010, there were the green shoots of the economy. Remember all that crap?
Oh, green shoots.
Green shoots. Yeah, and everything was fine, and they were going to normalize rates and flatten out the balance sheet. And what'd you get? By the economy slowed down in the first half of that year, and by November of 2010, we had QE number 2. Up went the metals. 2018, everything's great. We're going to keep shrinking the balance sheet. We're going to normalize interest rates. Everything starts to seize up and collapse. There's no liquidity. By June of 19, they're cutting rates. Up go the metals. First part of this year, everything's great. We're going to normalize the balance sheet. Come on, man.
Yeah.
So we're right on track. History has shown over the last 8 rate hike cycles, the period of time between the last hike and the first cut is about 75 days. Mm-hmm. So either they don't hike on Wednesday and the clock is, we're already 6 weeks into it, or they do hike Wednesday and we're on a schedule now of looking at maybe July for the first cut. That sounds about right.
I like that. I think you're 100% on the money, man. I can't see it. I can't see it any other way. It might be a little bit before, it might be a little bit after, but I would stake my money on July. And as long as we're in the prediction business today, I will predict right now, Bitcoin, kleptocurrencies, been on a tear. They're doing great. All the believers. I mean, you talk about gold bugs. Well, we got Bitcoin bugs, and they believe that it's going to infinity, right? But there's a little event coming up in Miami, the Miami Bitcoin Conference of 2023. It's coming up 5/18 to 5/20. Set your clock because it's going to crash. I mean, this is always the best indicator is the Bitcoin conference. And I'm sure we'll get lots of hate mail over this, but I'm telling you, it's going to happen. I know it.
Did it before.
2017, it happened. Last year, it happened. And get ready.
Yep. It again, doesn't mean it's going straight to zero, but you're absolutely right. The big holders know that there's going to be all this retail interest in buying Bitcoin again. Well, if there's all this retail interest buying, somebody is selling, right? Mm-hmm. And so, yeah, you're right. That's happened before. That's a word of the wise.
Yep. I'll be surprised if it doesn't. And the chart is looking really weak too, if you believe in such things. Apply to cryptocurrencies, and we're on the brink. What about the central bank digital currency?
Yeah.
Craig, is that coming? Are we just all acting paranoid, or is it real?
It's very real. People have watched you and I talk for the last 10 years. Well, remember how many times we talked about the war on cash, right?
Yeah.
We're going to get rid of physical cash. Then even in COVID, well, it carries germs. We got to get rid of cash.
We wouldn't want that to happen.
No. And, and it was always, the only people that use $100 bills carry are like drug dealers and bookies.
Of course.
Right?
Who else would use it?
Well, when you got a card, what do you need? And so they're eliminating that bit of your sovereignty and mm-hmm. putting, and then, and we've seen instances like go buy a gun with your Visa card, and it's noted with a certain code.
Yeah.
Okay. So this war on cash has been going on for a decade. This central bank digital currency is obviously a part of that. Whether it gets to, and I guess it probably will, I don't know how quickly it'll get there, but whether it gets to this draconian, horrible dystopian future where, you got to get the government's approval to buy a pound of bananas, with your currency, whether it gets to that, we'll see. But I think for now, why they're in such a rush to roll it out is so they can rescue these banks. You remember, it's Congress that has the spending power, right? And then the Fed buys the bonds, and then you get the cash out in society and all that kind of stuff. Remember back when everything was collapsing in 2008, And it was bank after bank. I remember the day that all of a sudden on CNBC, it was Goldman's turn. They were coming for Goldman. Well, then stop the presses. That was the end of that.
Right. Oh, yeah.
And now it was time for TARP. And remember the first time they rolled up to Capitol Hill about TARP, it was $700 billion and failed.
Yeah.
They had to get authorization.
Mm-hmm.
And it failed. And the markets melted down all this year. And then they ran up the Ben Bernanke up there to scare the crap out of everybody. Wall Street to Main Street and we got to pass this $700 billion. Okay, what a CBDC will do is it allow the Fed to kind of circumvent all that. You get an outlet like this First Republic Bank, but that's too big. Your local, again, First National Bank of whatever, and they've got $3 billion in deposits and $4 billion worth of liabilities, and they need $1 billion in liquidity to get right side up again. The Fed through a CBDC will just pump them $1 billion of ones and zeros, and nobody ever even has to know about it. I think that's the initial purpose of those things.
Oh, yeah. Well, and when you want to spur demand, because everything depends upon demand, hey, you got $5,000 worth of CBDC in your account.
Right.
However, it's a limited time offer. If you spend all 5,000 now, we'll give you another 1,000.
Right.
But if you don't, the freshness date, they're all money's going to have a freshness date now.
And have that expiration. You're reminding me, Kerry, last time I was mowing my lawn, I was doing it on my John Deere little riding lawnmower, Mm-hmm. I bought that sucker when we moved into our house in 2008, and I used my George Bush stimulus check. I got $2,400 check from the Treasury in the mail, and you were supposed to go out and spend it. Do you remember this?
Right. You're required.
It was stimulus.
Duty.
Deficit spending stimulus. You had to go out and stimulate the economy. Here's some money and go spend it, which is, again, so it's not like this is unprecedented. They'll just do it now in a different manner.
Oh, yeah.
And you're absolutely right. That's how it'll work.
Well, I'm expecting the Fed's going to take a book from the way banking was in the 70s and the 80s to get you to open a new account. They're going to give toaster ovens, waffle irons. I remember my bar mitzvah, I had all this money. We opened up like 8 different accounts. I got like clock radio, not that anybody uses them anymore. They'll probably get flat screens.
Right.
Open your CBDC currency account today and get a free 65-inch flat screen.
There you go. That's
Straight
exactly
from China.
right.
Straight from China.
These bastards. I mean, they pay nothing. They can go buy 1 year, 1 year T-bill for 5%, but yet you walk in and they'll give you 1% on a 5-year CD or a couple of pennies on your checking account.
Yeah,
or Kerry, they're charging us now the highest interest rate on credit cards ever.
Yeah.
Ever.
Well, they're going to
than the 80s or their late 70s. I mean, they're just criminals. So they all get bailed out in the end because, it's who I guess.
Bailout nation. But yeah, it's going to get real interesting. All those things that they come up with. They need Lee Iacocca to come back because he was the master marketer, and he could sell anything to anyone. So
prop up like Weekend at Bernie's. Prop up the corpse of Lee Iacocca.
Yeah. No one will know the difference. Everyone's dumbed down. So,
well, we got a corpse for president. Did I just say that?
Yeah. Well, no, you didn't say that. I misheard. Hey, I want to go back to a prediction that you made, a number of other metals analysts made, and everybody cried BS. And you know what that was? That precious metals prices would start to really go up when interest rates went higher. And everybody said, no, that can't be. Because, then the T-bills will be much more competitive against gold and people won't give up their T-bills. And what happened? We started this rate hike round, and what happened to gold?
How about that?
Yeah.
This is it again. It's such a simple. I don't know. I feel like I'm kind of snotty to say this, but it's such simplistic base level analysis to say those kind of things. Because it's all, put that in the same group of people that said, well, gold's no good. Look at inflation's 9% and it's not going up. So there you go. It's not even, look, it's not about the base level inflation. It's not about nominal interest rates. What will drive gold, what drove gold in the 70s, 80s, 90s, everything is real interest rates, inflation adjusted interest rates. And this is why the period we're entering into now of stagflation is going to be good for gold. It's just like stagflation in the late 70s, Kerry, when you were just getting back from Nam. It was good for gold because if you have negative real interest rates, which means the rate of return on your fixed income is actually over time, when you adjust it for inflation, negative, then gold, which doesn't pay a dividend, they always tell me, looks pretty damn good. And that's what we're heading into again. Fed is going to be cutting rates, and the longer term rates are going to be falling because people are looking at it, and looking for anything that they can do. And, we go from 3.5 down to 3, down to 2.5. But inflation expectations are remaining elevated and getting worse. And with stagflation, that's what happens. So you end up, when you compute your real interest rates off of current interest rates, but also inflation expectations, we're going to end up getting back to -1%, -2%. And that just drives gold higher and higher. Not straight up. None of this. I always laugh when I see people say, oh, gold, once it gets through 2,000, it's going straight to 3,000. I'm like, no, it's not. That's not how it works.
No.
It'll go to 2,300 and then it'll fool around for a while and consolidate, and everybody will get used to it. And then it'll go to 2,500 and it'll eventually go to 3,000, but it's not going to go from 2,000 to 3,000 in a month. That's just not how it works. And it's not just straight up inflation, or it's not just nominal interest rates that drive the price. It's those real interest rates.
Exactly. And they're still negative real interest rates, right?
Yeah. Right. Well, again, think of what drives the price sadly still in 2023 is the futures price. So you think of, okay, well, who buys and sells the futures contracts? Mainly hedge funds against the banks. And a lot of those hedge funds are done by algorithm, high frequency trading.
All of them.
And those funds are programmed to follow real interest rates. So not off just the month over month CPI, it's off of inflation expectations. So right now, the 10-year inflation expectations are about a little over 3%. The 10-year note's about 3.5%. And so you can calculate that as a positive real interest rate. What will happen is that 10-year inflation expectation will go to 4, and the 10-year note will go under 3, and now you're -1 again, and that's when gold just continues to rise and rise. It's not there yet, and gold won't break out. I've been saying this all year. It's not going to break out above 2,100 until finally we know that the Fed is cutting. Because until everybody's on that boat, you get things like today, where all of a sudden today everything's going up, and then the manufacturing PMI comes in 0.3% higher than expectations, and all of a sudden it's like, oh
my God, what are you doing?
Fed's never going to cut. What is one little thing? But all of a sudden, so once we remove all doubt that the Fed is now cutting, then gold will finally break out. But in between now and then, you still get these days like today where all of a sudden, maybe we should start hiking, putting in some rate hike odds for June. Give me a break. So it's just be patient.
The game continues until it stops.
Right. Yeah.
But then they'll come up with another game. We know that. We know how they work. Right. We know how it works. So, So interest rates are going to come down, but we could have the anomalous situation where rates come down, but the Fed's rates come down, but interest rates really don't come down at all.
You mean like on the midterm kind of thing, or mortgage rates, stuff like that?
Mortgage rates.
Yeah.
30-year doesn't really, 10-year doesn't come down that much.
Yeah. I don't think, absent, economic collapse, another pandemic, lockdown thing, I don't think we're going back to 1% on the 10-year note.
No.
And I don't think my current mortgage that I refinanced a couple of years ago at 2.75%, I don't think I'm going to let the bank hang on to that one as long as I can stand my house. Right. I don't think we're going back to that level anytime soon. But again, what will happen is what we've already seen. The 10-year note peaked at 440 and as recently as low as 330.
Yeah.
Okay. It's probably going to go under 3. And then inflation expectations, because the Fed, I mean, the genie's out of the bottle. They're not going to get it back down to 1.
Right.
Exactly. Expectations kind of it's a self-fulfilling cycle. You get inflation, and then it sticks around, you get more inflation, you start expecting more inflation, and the thing kind of builds on itself.
Exactly.
So the inflation expectations will go to 4 as inflation continues around 4. And that's probably, that's a long-term sustainable thing, a sustainable condition for bullish expectations for gold and silver. And that's where we're headed. Not to the moon, Alice, but consistently higher to the point where all the miners start making money again, that sort of thing.
Yeah, the miners. So let's talk about that.
Okay.
Because if there's one sector that's been the Rodney Dangerfield sector of the market, with a few minor exceptions, 16 in the height of the pandemic, March of 20, I guess that was. But other than that, this has been in the total crapper for the better part of a decade, since 12 years. 12 years.
Right. Oh, you're preaching to the choir there, Kerry. I know all about that. And I probably suspect most people listening to us do. I mean, there's 2 problems with the mining shares. One, nobody owns them. And so you get these long periods of time where they just do nothing except burn money. And then you get these huge surges, where all of a sudden, your neighbor's calling up his stockbroker at Merrill Lynch saying, hey, this gold's taken off. And the stockbroker, the only one he's ever heard of is Newmont. And so he sells the guy 1,000 shares of Newmont.
And Barrick, basically.
Yeah. And so you get all of a sudden these peaks of interest. Then the other thing that's been working against them is that, even as recently as 10 years ago, if you had like a part, you cut up your pie of your investment options, you had this little sliver of outside the dollar, non-paper kind of thing. And it was gold, silver, and maybe the mining shares. Well, now it's Bitcoin and crypto and all this other crap that siphons away buying interest from the mining shares. So that doesn't help. And then finally, the producers, they dig their product out of the ground for whatever they can sell it for. But the cost of digging it out of the ground is always going up because the major cost is is energy. And so their margins are constantly getting squeezed like this.
Let's not forget.
So it's kind of a threefold problem. But again, the biggest problem is if you get tired, just the minute you think, oh, I'm tired of these miners, they've done nothing for 3 years, you get one of those periods where they quadruple in 90 days.
Yeah, to the moon, Alice.
Yeah. So it makes it a very difficult sector, especially if you try to do it yourself.
And it's even worse.
Really hard to do.
There's one thing that makes it even worse. It's really 4 things. Is that all of these companies that are producing, in order to finance their operations, the banks require them to hedge, and they should hedge anyway, but they sell their production into the forward market. So when the market takes off and 70% of their production is hedged, they see virtually no profit increase.
Right. And then they're hedging while the price is going up, putting a cap on the price.
Exactly.
I mean, it's just maddening. Or I'll give you one more, Kerry. I'd never even thought about this before. But, I started doing those things, these weekly things with Eric Sprott 5 or 6 years ago, and he and I kind of become friends. And I was talking, so I'm not like trying to be like Mr. Name Dropper, but I was talking to Eric Sprott last week, and here's what he told me.
When Eric speaks,
but I'd never thought of this. He goes, think of what a scam this is. If in Canada, you can naked short sell things to death. There's actually a thing called this.
Yes.
It's called the Save Canadian Mining Initiative. Ever heard of that?
No, but I know.
Okay, well, anyway, you can just naked short sell things to death. And so if you're an exploration company, it costs a lot of money. You might need $10 million a year just to keep going. So you got to constantly keep coming back and diluting your stock by doing these private placements. Well, Eric goes, well, here's where it's such a scam. Broker hears about the private placement. They call up their hedge fund clients.
They're shorting.
They short the shit out of the stock, take the proceeds from shorting it,
and buy,
do the private placement, get the stock from the private placement, and repay the short.
All right. So that is a great point you raise. And there was an article in Zero Hedge I'm sure you caught it a year or two ago. Canadian brokers can naked short any stock for 10 days.
Yes.
All right. Because I believe the theory of naked shorting was we know the shares are being shipped from New York or from Toronto or wherever, but we need to lock in the price now because otherwise the risk gets
Yeah.
too high while we're waiting for
Yeah.
the certificates. So we short them, right?
Yeah.
But that leads to, all right, we're going to close the position in 10 days, but on day 9 or every day we're closing a 10-day position, we're opening a new 10-day position. So, and each time they do it, they got to increase the number of shorts. So it's a cascading thing. And then when some unforeseen development hits, you see parabolic moves in these companies that may or may not be worth anything, but they're juniors, micro caps. But all of a sudden, something happens and everybody runs to cover.
Has to short it, cover it. Yeah.
And then you have multiple trading stops in these stocks.
Yeah.
And it happens periodically. I'm not going to name. I know somebody who was involved in one of these companies, and the company did a couple of things. And as a result, everyone had to cover it once, and it went from $3 to $15.
Yep.
2 days.
Yep.
With probably a dozen trading stops.
Right.
Because why do they do trading stops, Craig?
Right. Right. Yeah.
Right? Can't
But
get
then,
the stock.
and then the sad part is the retail guy that doesn't know how all this stuff works thinks, well, now it's 15, it's going to 45.
Yeah.
And then it goes right back down to, to 4 as they come back in and short it again.
Yeah.
But I think what a scam that is. You can sit there. I mean, this company's just trying to stay afloat, and they end up having to raise cash because they're getting shorted to death anyway. Mm-hmm. And then the company, so they do a offering of, $10 million at 1. And it's, so that gets announced. Hedge fund shorts the crap out of it at 1, goes all the way down to 70 cents. And they take their shares at 70 cents and cover their short.
All right. But going back to the Canadian thing, and it's even worse than that, because there are certain really well-heeled investors that while they don't own brokerage companies, Canadian brokers, they effectively control them through their order flow and through their volume. So individuals can't do this. They have to settle within 2 days, and a new rule got passed by the Canadian regulator that they have to know they have the shares before they can short them, right? Reasonably believe that they'll be able to obtain the shares in the next 2 days, but it doesn't apply to brokers. So effectively, these well-heeled investors avoid the entire regulatory scheme.
Yeah.
And the other thing, Craig, is that from my knowledge, and correct me if I'm wrong, brokers don't have to report their short positions.
In Canada? I don't know.
I think that to be true. If anybody knows otherwise, please let us know. I don't want to be disseminating false information, but from other people I've heard, they don't have to disclose their short positions. It doesn't get reported on the short interest reports because they're market makers and they buy and sell for their own account, and they do what they do.
Right.
Right?
Yep.
So if I'm wrong, though, I'll stand corrected. I'd love to hear from any of you out there.
Yeah.
So that's just some of the obstacles, but we're getting to a point where I think any idiot with $10,000 can make a boatload of money in mining shares. We're not there yet, but that could happen any day.
Yeah. It's again one of those massive runs in like in 2016.
Yeah.
Which was another period where the Fed was playing the rhetorical games about hiking rates and all that crap. And all of a sudden the economy slowed down. Mm-hmm. And like the Hui index went from 100 to almost 300 in 8 months.
Yeah.
So it's there. It happens.
Yeah. And the smart companies that you and I hopefully invest in and certainly cover, all of them use that time in 16 and then also in 20 to raise capital.
That's the time.
Yes. Their stock became liquid. Right now, these stocks are illiquid. Nobody wants them, but all that's about to change. Hey, Craig, tell us, how do we become members there of tfmetalsreport.com and what's in it for us?
Well, first I want to send everybody to my new website, Craig and Kerry's Short the Shit Out of Canadian Miners Fund. SSCM, I
I'm
think is
buying the
symbol.
URL as we speak.
Yeah, there you go. And then we're going to be in trading places, or I'm on the beach feeling good,
Yeah.
Kerry.
I love it.
Yeah,
Man.
look,
I love it.
I joke, but I mean, if you can't laugh at how corrupt everything is, then you're just going to absolutely drive yourself bananas, And like today, I mean, at one point, silver was up 95 cents, and then because the manufacturing PMI for this month came in 3 ticks higher than it was exposed to be, the dollar went up 40 cents, and silver went back down 4%. What?
Yeah. Silver was
What
about
does
to
that have
hit
to do with anything?
26, right?
So if you're going to keep your sanity, if anything, maybe my site will help you do that.
Yeah.
A
Hey,
TF Metals report. I
try.
there's content every day, and hopefully people think it's valuable.
We'll try to help you keep your
Thank you.
sanity. There's no guarantee, but
Right,
hey,
no guarantees.
there's links to the new site and to Craig's site in the show notes on financialsurvivalnetwork.com, and just sign up for your free newsletter while you're there. And hey, got a question for Craig or myself? Shoot us an email, kl@kerrylutz.com. We've been talking about this stuff for the better part of 10 years, actually 11, Craig. And exactly what we said is coming to pass.
Yeah.
So
yeah,
that speaks volumes. Beware of Bitcoin again, because the BTC conference is coming up in Miami, 18th to the 20th of May. And mark my words, it could very well be a peak. I can't tell you for sure, but it certainly worked that way in the past. All right, Craig, thanks. We'll talk to you again soon, man.
Always good to see you, Kerry.